In 1980, two brothers from Texas got so aggressive buying silver that they accidentally controlled nearly a third of the world's entire private silver supply. Then, in a single week, the price collapsed by over 50%, and it took down a Wall Street firm with it. That event is still called Silver Thursday. And the reason I'm bringing it up right now, today, is because the setup in the silver market this week is starting to rhyme with moments in history that came right before major price moves. Not identical, not guaranteed, but similar enough that if you own gold, silver, mining stocks, or you've been sitting on the sidelines wondering if you missed your window, you need to understand exactly what's happening before markets open Monday morning. Here's the thing about precious metals. Most people only pay attention to gold and silver when it's already too late. They watch the price rip higher on the news, they panic, and they buy right at the top. Then the pullback comes, they sell in frustration, and they walk away saying precious metals are a scam. That is not what this video is about. This video is about understanding the actual mechanics driving gold and silver prices right now, in plain English. So you're not reacting to headlines, you're anticipating them. Over the next 20 minutes, I'm going to walk you through four things. First, why silver behaves so differently from gold, and why that difference matters more than most investors realize. Second, the historical pattern of what happens to precious metals when the Federal Reserve changes course on interest rates. Third, the current relationship between central bank buying, the US dollar, and inflation, and how those three forces are colliding right now. And finally, what serious, level-headed investors are actually watching for going into next week versus the noise you'll see on social media. I want to be upfront with you. I'm not here to tell you gold is going to hit some specific number by some specific date. Anyone who tells you that with certainty is selling you something. What I am going to do is give you the historical context and the current landscape so you can make your own informed decision. Let's start at the beginning with a question most people never bother to ask. Gold and silver get lumped together constantly, as if they're the same asset with different price tags. They are not, and understanding why is the key to understanding everything else in this video. Gold is, first and foremost, a monetary metal. Central banks hold it in vaults. Governments settle trade imbalances with it historically. Investors buy it as insurance against currency devaluation. Only a small fraction of gold demand each year actually goes into industrial use. That means gold's price is driven almost entirely by how people feel about currencies, debt, and geopolitical stability. Silver is different. Silver lives a double life. About half of all silver demand comes from industry. Electronics, solar panels, electric vehicles, medical equipment, and yes, even the connectors inside your phone. Silver is one of the best conductors of electricity on the planet, and modern technology cannot function without it. But the other half of silver demand behaves just like gold. Investors buy silver coins and bars as a store of value, the same way they'd buy gold, just at a lower price point. This split personality is why silver is famous for something traders call amplified moves. When gold goes up, silver often goes up more, percentage-wise. When gold goes down, silver often goes down harder. Traders sometimes describe this using the gold to silver ratio, which is simply how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has swung wildly, sometimes sitting near 40 to 1, other times stretching past 80 or even 100 to 1. When that ratio gets historically stretched, some investors see it as a signal that silver is undervalued relative to gold, and that's exactly the kind of signal that gets serious money paying attention. There's also something structural happening in silver that doesn't get nearly enough attention. Unlike gold, which is mostly mined on purpose because people want gold, a significant portion of silver is actually a byproduct. It comes out of the ground while mining for copper, zinc, and lead. That means silver supply doesn't respond quickly to price. If silver prices spike, mining companies can't just flip a switch and produce more because most of it is coming along for the ride with other metals. When you combine rising industrial demand from things like solar energy and electric vehicles, with investment demand that surges during uncertain times, and a supply chain that can't react quickly, you get a market that is structurally prone to sharp price moves in either direction. This is exactly why silver alerts get so much attention online. It's not hype for the sake of hype. Silver genuinely is a more volatile, more reactive market than gold, and that volatility is precisely what we need to talk about next, because it connects directly to the single biggest force influencing precious metals prices this year. If you've watched any financial news over the past few years, you've heard the phrase, the Fed, more times than you can count. But here's what most coverage gets wrong. They treat Fed decisions like isolated news events, when in reality, the Fed's actions are the backbone of how gold and silver are priced globally. Let's break down why, because this is genuinely simple once someone explains it clearly. Gold and silver don't pay you interest. If you hold a bar of gold in a vault, it just sits there. Compare that to holding cash in a savings account or buying a government bond, both of which pay you a yield. When interest rates are high, holding gold has what's called an opportunity cost, because you're giving up the interest you could have earned elsewhere. That tends to make gold less attractive during periods of high rates. But when the Federal Reserve starts cutting interest rates or even signals that cuts are coming, that opportunity cost shrinks. Suddenly, sitting in cash doesn't look as rewarding, and gold's appeal as a non-yielding safe haven increases. This is one of the most consistent relationships in financial markets, and it has played out repeatedly throughout history. Look back at the early 2000s. The Fed cut rates aggressively after the dot-com crash, and gold began a multi-year climb from under $300 an ounce toward record territory later that decade. Look at 2008 and the years following the financial crisis. The Fed slashed rates to near zero and introduced massive bond buying programs. Gold surged to what was then an all-time high by 2011. Then look at 2019 into 2020, when the Fed cut rates again heading into the pandemic, and gold once more climbed to fresh records. This is not a coincidence, and it's not some secret conspiracy. It's simple economics. When money becomes cheaper to borrow and safer assets pay less, investors look for other places to park their wealth, and precious metals have been one of humanity's oldest answers to that problem for thousands of years. Now here's where it gets interesting for silver specifically, because silver carries that industrial demand component we talked about earlier. It doesn't just respond to interest rate expectations, it also responds to economic growth expectations. When the Fed cuts rates to stimulate a slowing economy, that can be a double-edged sword for silver. On one hand, lower rates make silver more attractive as an investment. On the other hand, if rates are being cut because the economy is genuinely weakening, that can dampen industrial demand for the metal. This is part of why silver can sometimes lag gold in the early stages of a rate-cutting cycle, before catching up and even outperforming later on, once investors become confident that economic growth is stabilizing rather than collapsing. Understanding this relationship is exactly why so many precious metals investors have their eyes glued to every single word coming out of Federal Reserve meetings. A single sentence change in a Fed statement, the difference between saying inflation is elevated versus moderating, can send ripples through gold and silver markets within minutes. This is not exaggeration. This is literally how these markets have traded for decades. So when you see headlines calling for a silver alert tied to what might happen Monday, this is almost certainly the mechanism underneath it. Markets are constantly repricing expectations about what central banks will do next, and precious metals sit right in the middle of that repricing. But interest rates are only half of this story. There's another major player that's been quietly reshaping the gold and silver landscape over the last several years, and most retail investors have no idea it's happening. Here's something that doesn't get nearly enough mainstream coverage. Central banks around the world, not individual investors, not hedge funds, but actual national central banks, have been buying gold at some of the fastest rates seen in decades. Think about who does the buying here. Countries like China, Russia, India, Turkey, and Poland have all been notable buyers in recent years. According to data regularly published by the World Gold Council, this isn't a secret, it's publicly tracked. But the reasons behind it tell a much bigger story about the global financial system. For decades, the US dollar has functioned as the world's primary reserve currency. Countries hold dollars and dollar-denominated assets like US Treasury bonds as the backbone of their foreign currency reserves. But several major geopolitical events over the past few years have made some countries increasingly nervous about being overly dependent on any single currency, particularly one that can be influenced by sanctions or political decisions made in Washington. Gold offers something dollars and bonds don't. It's not anyone else's liability. When a central bank holds gold in a vault, the gold's value doesn't depend on another government's promise to pay. It has been recognized as valuable across every culture and every era of human civilization for thousands of years. That's an extraordinary track record, and it's exactly why central banks have been diversifying a portion of their reserves away from currencies and into physical gold. This buying trend matters enormously for the price of gold, because central banks aren't day traders. They're not buying and selling based on short-term price swings. When a central bank decides to build a gold position, it tends to do so steadily over months and years, creating a consistent source of demand that acts almost like a floor under the market. This is fundamentally different from retail investor behavior, which tends to be much more reactive and emotional. Now, silver doesn't get anywhere near the same level of central bank buying, because central banks are primarily focused on monetary reserves, not industrial metals. But here's the connection that matters. When gold demand strengthens due to central bank buying, and gold prices rise, that tends to pull silver along with it, especially once that gold to silver ratio we talked about earlier starts to look stretched. Investors and institutions looking for value often rotate into silver, specifically because it hasn't kept pace with gold's gains, betting that the gap will eventually narrow. This is part of what analysts mean when they talk about silver catching up. It's not silver moving on its own logic in isolation. It's silver responding to a gold market that's already been reshaped by years of aggressive central bank accumulation, combined with silver's own industrial demand story from solar energy and electric vehicles layering on top. Put these pieces together and you start to see why precious metals commentary has gotten so loud lately. You've got a Federal Reserve whose next moves on interest rates are being scrutinized sentence by sentence. You've got central banks around the world quietly and steadily accumulating gold for strategic reasons that have nothing to do with short-term trading. And you've got silver, structurally supply constrained and increasingly demanded by clean energy technology, sitting historically undervalued relative to gold by traditional measures. None of this guarantees any specific price move by any specific date. I want to be very clear about that, because anyone claiming certainty in these markets is not being honest with you. But it does explain why so much attention is being paid to precious metals right now, and why alerts like the one referenced in this video's title tend to circulate whenever these forces line up simultaneously. So, what should you actually be watching for going into next week? Let's bring this all together. If you strip away the social media hype and the dramatic thumbnails, professional precious metals investors tend to focus on a fairly short list of concrete indicators. And I want to walk you through them so you know exactly what to look for yourself. The first is Federal Reserve communication. This includes official meeting statements, but also speeches given by Fed officials in the days surrounding those meetings. Markets pay extremely close attention to language changes because the Fed rarely makes dramatic announcements out of nowhere. Instead, it tends to prepare markets gradually through careful wording. If you want to follow this yourself, the Fed publishes its statements and speech transcripts directly on its own website, which is a far more reliable source than secondhand headlines. The second is inflation data, specifically reports like the Consumer Price Index and the Personal Consumption Expenditures Index, which is the Fed's preferred inflation gauge, higher than expected. Inflation readings can shift expectations about how aggressively the Fed might act, and that shift tends to move gold and silver prices within minutes of the data being released. The third is the US Dollar Index, which measures the dollar's strength against a basket of other major currencies. Gold and silver are priced in dollars globally, so when the dollar weakens, it often takes fewer of those weaker dollars to buy the same ounce of gold, which tends to push prices higher, and the reverse tends to happen when the dollar strengthens. This inverse relationship isn't perfect and can break down during certain periods, but it remains one of the more reliable relationships in the market over long stretches of time. The fourth is what's happening in the futures and options markets, specifically things like open interest and positioning data published by the Commodity Futures Trading Commission. This data shows how large institutional traders are positioned, whether they're leaning bullish or bearish, and sudden shifts in this positioning can sometimes precede larger price moves. And the fifth, which ties everything together, is simply paying attention to whether central bank buying reports continue at the pace they've shown in recent years, information that gets updated periodically through sources like the World Gold Council. Now, here's my honest take, and I want to be clear, this is analysis and opinion, not a guarantee of any kind. The combination of a Federal Reserve that appears closer to the end of its tightening cycle than the beginning, continued strategic central bank gold buying, and a silver market that remains historically cheap relative to gold by the ratio we discussed earlier, creates a backdrop that has historically been favorable for precious metals. That does not mean prices move in a straight line. Markets never do. There will be pullbacks. There will be days that feel scary if you're holding a position. Volatility is not a bug in this market, it's a defining feature of it, especially in silver. What I'd encourage you to do, regardless of what happens Monday or any single day after that, is to think in terms of years, not days. The investors who have historically done well in precious metals were rarely the ones trying to perfectly time a single week's news cycle. They were the ones who understood the underlying forces we just walked through, positioned themselves based on their own risk tolerance and financial goals, and had the patience to let those larger trends play out. Let's bring this back to where we started. Back in 1980, the silver market got distorted by two individuals trying to corner an entire global market, and it ended in a dramatic, painful collapse. That is not what's happening today. Today's story is different. It's being written by interest rate policy, by central banks quietly repositioning their reserves away from single currency dependence, and by a genuine industrial demand boom driven by solar energy and electric vehicles colliding with a silver supply chain that simply cannot expand quickly. If you take one thing away from this video, let it be this. Gold and silver do not move because of headlines alone. They move because of the underlying mechanics we just covered: interest rates, currency strength, central bank behavior, and supply and demand fundamentals. Headlines are just the surface. What we walked through today is what's actually underneath. Whether you're already holding physical gold and silver, you're invested through mining stocks or ETFs, or you're simply watching from the sidelines trying to decide what to do next, Understanding these forces puts you in a completely different position than someone who's just reacting to whatever dramatic thumbnail shows up in their feed. Markets reward people who understand what they're looking at, not people who panic at every headline.